Hello, and welcome to what is perhaps the most excited I've ever been to record a podcast. I'm not even going to give you any more than that. We're just going to get right to it. So here we go. Bank Nerd Corner is back. I am so excited. This is the long-awaited, much-anticipated return of Kiah Haslett. Kiah, it is absolutely amazing to be doing a podcast with you again.
Oh my God, yes. I'm so happy to be back. And this time as your coworker, which is the craziest kind of leveling up that I could probably have. When you like get traded and then it's like.
Totally.
Yeah. So
totally.
The sports analogy ends there, so unfortunately. No, but yes, this is crazy.
It's the best. I mean, so we, for the years that we were doing the podcast, there's always a note at the beginning, which is like, because I would screw up your job title, right? I would like get that wrong. And so you'd put like a note and be like, my job title is this. Please don't mess this up. Well, now I'm not going to mess this up because Kiah has joined Fintech Takes. We are so excited to have you as a part of the Fintech Takes network, creating content for Fintech Takes. I don't know, man. Like we started this podcast years ago, specifically because I wanted to nerd out about banking topics more than I was doing before.
Sure.
And you were the perfect person to do that with. And now you're going to be doing that full time at Fintech Takes. Kiah, this is like a dream come true for me.
Honestly, I think you need to be careful what you wish for, because if you were like, I'm not nerding out about bank topics enough, so let's start a monthly podcast.
Sure.
And then you're like, it's still actually not enough. So can we get like a weekly newsletter?
Right.
Okay. Yeah.
Sure.
Now we're increasing. Like that's like, I can't even do math, but a big increase.
Yeah, big jump. And
then it's going to be like add or layer weekly podcasts on top of that. All of that.
Yes.
And I feel like that's like threshold nerdiness. Like, I think we've like maxed out.
Well, so on that note, a couple things for listeners just to get you excited about this, because it's going to be amazing. Kiah, as just Kiah outlined right there, there's going to be a weekly newsletter, right?
Yes.
What's the newsletter called?
It's Fintech Takes Banking.
Which I love on a number of different levels. I don't think I thought at the time that I came up with the name Fintech Takes, which I'll be honest with you, I did not spend a lot of time on. But when I thought of that, I did not think about Fintech Takes something coming after that. But like Fintech Takes Banking, like that is amazing. So weekly newsletter, Fintech Takes Banking. I know what it's going to be about because I've gotten a preview of some of the pieces, but you don't have to tell us the topics, but like on a nerdiness level, like what are we talking about here?
Okay, I actually I'm a little worried that everyone says they want bank nerdiness,
sure.
I'm not sure they really know the depths. I don't know if they're prepared for the nerdiness. I like, before I joined this podcast, I used to write a lot about accounting, and it was like my little thing that I loved and gave me joy. And it's like for everyone else, it's like going to the dentist, and for me, it's like really fun and interesting. And I just don't know how ready people are for those topics again, right? Like, and so I keep having to tell myself, like, people who are receiving my newsletter did sign up for it, you know? Like,
they asked for this. That is totally fair. And I just to give people the appropriate warning / really like get you excited for how nerdy it's going to be. Kiah, because she, unlike me, eats her vegetables and gets her work done in advance, has been doing a great job already creating a bunch of content for the launch of Fintech Takes Banking. I have had the privilege of reading a few drafts in advance. And Kiah, all I can say is there are some really gross words in accounting that you didn't tell me was going to be happening. And I keep reading these drafts being like, is she messing with me with this? Is this a real thing? Grossing something up. That's something that we're doing here.
You know, in accounting, like, I assume everyone kind of knows that these terms have Urban Dictionary like entries.
Yeah.
And we've never talked about it. We just like, these are serious people, Alex. And I'm not going to be the one to bring up like a little giggle when they say certain words. Like we're all we just pretend like this is the only definition this word's ever had. And it's the only way this word can be used. So
I feel like what I'm going to need to do is be like the drop-in editor's notes being like, Kiah, are you for real? Are you for real with this? Are you trying to kill me with this? I'll be the kid in biology class who laughs at all the serious sounding words that are actually ridiculous. Okay, so we have the newsletter. It's coming out once a week. Where, by the way, people can go to a place and sign up to get on the list. They sure
can. Right? Let me find the URL, and I'm sure it'll be included in the show notes.
We'll put it in the show notes.
It is fintechtakes.com/banking/newsletter-subscription. I wonder if you can Google me yet. I should check that.
I think you probably can. And I mean, you're famous. You were well before you joined Fintech Takes. And now we're just doubling down on the nerdiness. For folks listening, please do sign up if this sounds like it's up your alley. I kind of guarantee that it will be if you're listening to this podcast. So definitely sign up to receive Kiah's newsletter. Kiah, roughly when should people expect these things to happen?
September is what I've been told, and that's what I'm working towards. So I'm trying to knock out as many really nerdy topics. So there's M&A, regulatory, legal, there's operations. I really want to write like some joke articles that I've like mentioned over the years, and really, just never worked at a place that would let me publish those. So I'm pretty excited about those.
That is wonderful. And I will say, and on a sincere note, listeners to this podcast have over the years, I think, benefited both from your analysis and the research and the diligence with which you study the banking industry, but also your personality and the jokes and the asides and the, I can't believe this is a real thing. Why are we talking about this? And that's going to come through in the newsletter, I think, in a way that, to be totally candid, I've really always wanted more of in your written content. So I can't wait for that. I really am genuinely excited about that. I also am excited for you to essentially like seize the Bank Nerd Corner podcast and take it.
Yeah, this is
a
coup.
And run with it. This is a coup. That's what we're listening to right now, is a real-time coup that is happening. Please explain what you're doing and why you're doing this to me.
So, well, I'm better at it. So let's start with that. Back when I was a guest, the monthly co-host guest, I allowed you to have it. And now I'm seizing the means of production and will be taking over it. The podcast launched in October. I have been thinking a lot about the different types of podcasts we could do, the different, I don't want to, I'm mostly driven by creating things that I would like to read but haven't come across. And so then I'll just have to write it myself. And so I've been thinking about what could I do for podcasts and who can I bring on for what kinds of conversations and show formats or whatever. And I've been toying with a legal one because that's come up a lot in our conversation. So that launches in October. Again, I have to get up to speed. I have to work ahead. I have to find these people. So if you have, and you and I have had so many guests on our show, and I really think that people like coming onto the show and talking about their nerdy bank thing, and then people enjoy listening to it. And I feel so good about the work we've done on the master accounts and on the BSCA and, Mike Sue coming on to play Would You Rather. So I'm hoping to do more of that.
Excellent. Well, may I make a small request? Because I know that you're seizing the means of production and I don't have any choices here. But just if I can gracefully step aside and then ask, would it be possible, Kiah Haslett, for me to still come on your Bank Nerd Corner podcast every month? And that maybe I can be the guest host who just sort of follows along and you tell me where to go. Can we still do this podcast together in addition to all those other great shows under the Bank Nerd Corner umbrella that are going to be happening?
Yeah, I think one of the most important things about joining Fintech Takes Network is that, like, the appreciation I've come to have that there's a big overlap between financial technology and banks, or non-banks and banks. And so I actually think like we're going to be able to have even more of these conversations now that I'm your coworker, and they'll be kind of moving off of Slack, or they'll be moving out of text, and we'll just be able to have more of them and continue the OG Bank Nerd Corner while expanding the universe of bank nerdery.
Yes, that's the perfect way to describe it, right? So for listeners, Bank Nerd Corner is going to become its own podcast feed. Kiah will be the host of it. I will still be coming on as a guest every month, but there will be other smarter guests who can get into other like nerdy areas within the Bank Nerd Corner universe. I'm so excited for the podcast to launch in its official way and to grow out of what we've been doing for the last couple of years. As Kiah said, that'll be starting in October. And then finally, Kiah Haslett, you've already been doing this, but now even more so, the Fintech Takes Network is kind of becoming a place for more bank nerd conversations,
we're also going to do a small takeover. Or there's going to, we're going to have warring factions, maybe?
Warring factions. I like that. Okay. That makes sense. So there'll be like sort of the unrepentant bank nerds in there. There'll be more of like my sort of fintech people in there. We'll try to maybe come to a truce on certain topics, maybe like open banking, where we try to get on the same side. Little hint of what we're going to be talking about in the podcast today. Okay. So if you want to get access to all of Kiah's brilliance, and you should, continue to listen to the Fintech Takes podcast, where at least for the next couple of months, maybe we'll do this before you officially seize the reins of production. Then the Fintech Bank Nerd Corner podcast will spin off into its own universe. Fintech Takes Banking will be starting in September. We'll drop the link to subscribe in the show notes. And then, of course, the Fintech Takes Network, our professional networking platform and community for bank and fintech operators, that is available to anyone who wants to apply to be a member of it. And there'll be lots of nerdy bank conversations happening there. Sure will. Well.
Yeah, there's going to be just skyrocketing bank nerdery in all these venues.
Well, speaking for myself, speaking, I think, for the audience, speaking certainly for all of your new colleagues at Workweek, we're all delighted that this is happening. So, yay, this is so fun. I'm so happy to be back. And Kiah, in the interest of us coming back, I didn't just want to do this podcast and talk about you joining, although that's the headline news. That's the breaking news, obviously. I thought we also could maybe banter about a few bank nerd topics for old time's sake. Does that sound okay?
Yeah.
Okay. Well, let's hit a couple topics, some of which I've talked about in other venues, but haven't talked about with you, at least not on a podcast. You and I have talked about these things. And then also some topics that I don't think really anyone's been talking nearly enough about, and that I wanted to have you on to talk about. So can I go first?
Absolutely.
All right, so I want to talk about the topic that's probably going to end up on my tombstone when I die, open banking. Obviously, folks who are listening know that there's been a lot of drama in the open banking space recently. To do a quick review of where we are at the moment, and by the time folks listen to this, I will have also published an episode with a special guest on open banking that gives a really deep dive into this subject. So I'm not going to repeat all of that, but just to bring us up to speed with where we are right now. And again, this is a topic where things seem to change on a very rapid basis. So this might not be totally up to date by the time you listen, but in general, what we know is that the CFPB requested and was granted a stay by the court in the BPI litigation so that it can initiate an accelerated rulemaking process to revise the existing rule and address industry concerns, such as the ability for banks to charge for access to the data. This obviously was precipitated by JPMorgan Chase pricing for the data without the rule allowing them to do that, but sort of in the absence of dad being at home watching the kids. This is sort of what happened. And now the Bureau has stepped back in and said, nope, we're actually going to revise the rule, and we are going to try to address some of these concerns while making sure that the industry, I guess, plays by at least some set of rules, or at least acts in a somewhat orderly fashion. And it's been reported by our friends at Bloomberg that that process has already begun. The Bureau is meeting with stakeholders and appears, according to the reporting, to be receptive to a number of changes, including allowing data providers to charge for data. This will then obviously manifest itself more formally in an advance notice of proposed rulemaking, an ANPR, which is essentially just a document that the CFPB will publish asking for input from the industry, and that will kick off this accelerated rulemaking process. So, Kiah Haslett, what are your takes on all of this? I haven't gotten to get you on the record on any of this. What do you think about all of the drama that's been happening in open banking land?
Well, I think I first need to apologize because I had connected 8 of my 9 Chase accounts, which is my 8 credit cards from Chase and my debit card, to my YNAB account. I didn't realize it was causing so much API traffic for my bank.
You're like single-handedly like submarining their profitability as a bank.
I didn't know. I can see how many times the API kind of calls. Like you can kind of see it when your budget updates every day.
You're the problem.
I know. I didn't realize
batch
it.
Requests.
I'm so sorry, you guys. I didn't know. The second thing is like, one, I'm a Chase customer. I don't know if that's obvious. Like I don't have any beef with Chase or against Chase for Chase, whatever. But I can't imagine doing something that's so unilaterally unpopular that the regulator, which has already switched sides once in this case, switches sides again. I also do think I don't know exactly what this says about the CFPB's argument and authority that they were presenting from a legal perspective, but it's not a good look.
It's kind of weird, right? To go to the court and be like, you know what? These guys are right. We should just throw the rule out entirely. We don't need this rule. And then to go back and say, actually, on second thought, based on, I think they said developments in the market, which was code for Chase doing this thing. Right. On second thought, we actually maybe need rules. I mean, I've compared it before to sort of an escalating contest of hold my beer. It felt like the vote CFPB and Chase were engaged in this let's see who can outdo each other with a crazy thing in open banking, and it, basically Chase went too far and basically got them to just if you're playing a game of chicken, this was where vote swerved off the road and was like, no, we can't do this. This is crazy.
Well, the other thing too is you said Chase went too far, and I think they went too soon. I think their timing was bad and it was too early specifically, because what would have happened if Chase, what would have happened if Chase did nothing for 2 months and then pulled this exact same move or something? Once
the rule was actually vacated.
Yeah, if the case itself had gone farther on its original the second path that it was on, and then Chase pulls the exact same stunt 2 months later, I think then the CFPB was like, oh no, we did this whole case. The court vacated as we asked them to potentially. And now we have so much less, I don't want to say power. That's wrong. That's the wrong way to say it. But we kind of miss our window of opportunity to do something the way that the CFPB is, I think, responding to its window of opportunity now. And it is it's not a great look, but at least they're doing the thing they think they should do when they can do it.
Well, and to that point, from a timing perspective, I think one thing that's important to emphasize is if the rule had been vacated, then even if the CFPB had said, okay, we're going to work on a new rule, you're working in the absence of any rule being in effect. Yeah. And that's a huge deal, right? Because in that environment, then it's just market power, baby. Big guys set the rules, and Chase is obviously the biggest, and so they could set the rules. The problem is, and I think you make a great observation, by going too early, and by sort of kind of forcing the CFPB's hand a bit into doing this. And I do think we should acknowledge the work, I think, that the fintech community did to make this a big deal. And I'm not saying
I can't thank crypto for anything. So I'm you can do that, but I'm just going to be
I'll do it. I'll say, I watched the Social Network movie like everyone else did. I wouldn't say I'm the most sort of generically predisposed to like the Winklevoss twins, but like Tyler Winklevoss tweeting might have actually gotten the job done here. And the timing thing that matters is we have a rule. The rule is in effect. Some of the compliance deadlines haven't hit yet, but like the rule is finalized. It is on the books. It is in effect as of January of this year. And so now the playing field that you're operating on, if you're Chase and you're trying to steer this in a direction that you want, you have less leverage and you are naturally constrained by the rule that's on the books that you don't really like. And then Kiah, I guess the other thing I want to get your take on is, like, in terms of what might happen next, I've been trying to sort of caution the industry a bit that banks actually got a lot of what they wanted the first time around.
Yeah.
And it never feels that way, right? Like whenever a rule comes out, especially if you're the incumbent, you're like, oh, like, we don't love this. We don't love this. Everyone was kind of grumbling when they walked away from the table the last time. But like, if you think about it, fintech companies wanted much looser restrictions on secondary data use. Mm-hmm. Fintech companies wanted a much more expansive rule that covered more types of data beyond credit cards and deposit accounts. You know, fintech companies wanted a whole bunch of things that they didn't get.
Yeah.
Because, you know, as much as Rohit Chopra was not exactly a friend to banks, it's not like he was a friend to fintech companies either, right? Like he was kind of not a friend to anybody, except arguably the consumer advocacy groups. And as such, like, you know, everyone kind of lost to a degree in the last rule. And I would argue somewhat evenly.
That's what happens with rulemaking. And that's what should happen with like good rulemaking. Like an observation I would make about the previous process and then questions I have about this next process is when everyone kind of feels like they lost, I think that's like, I don't know, sometimes in soccer, something will happen and both teams think they were fouled and I won't have a foul or something. Like I just will be like, nah, that's fine. And then I'm like, that's probably correct, right? Like if both people think that they're the victim and someone else wins, like I think that's probably like an outcome that I think like at least reads that the process was fairer than what I'm now worried about with this like Winklevoss tweet signaling is that the CFPB is influenceable in a certain way. Or the CFPB's boss is influenceable in a certain way. And so maybe the CFPB saw what Chase did and was like, oh my God, this isn't fair.
Yeah.
We should use our power as a regulator and as vested by the Dodd-Frank Act to like intervene. Mm-hmm. But I don't think that happened. The amount of time that passed between those the Chase rule and the CFPB announcing this indicates that that's not what happened. And so actually what I would question is who is the CFPB going to listen to and where is that balance going to be struck? And the other thing too is like, I also like kind of in a prisoner's dilemma, are the big banks going to play nice? Like what if we do this ANPR and they still don't think they got what they deserved? And then they pull the same move. They file within 24 hours after the rule. Yeah. Like, why would I trust Chase to participate fully and fairly and to accept what the CFPB decides afterwards? Like, this whole process makes me like really question all the players in the process in a way that feels worse than the first time this happened, right?
I very much agree, right? I mean, I can tell you, I was at Money 2020 last year, right when the rule was, after the rule had been finalized. So it's finalized like the week before. BPI filed this lawsuit like minutes after the CFPB finalized its
in
rule.
Kentucky of all places.
In a
the like what we call the open banking mecca of America, right?
Exactly. Yeah. It's not court shopping, Kiah. That's that's the white hot center of open banking.
Right. It's like the Delaware Chancery Court, but for fintech. Okay.
Right. Exactly. Like it's like a total neutral playing ground. And, you know, I was talking to a lot of fintech folks and a lot of bank folks at Money 2020. And I can tell you that, like, one of the things that was a real emotion, and sometimes like emotion and relationships are a big part of this stuff. I can tell you that everyone who was involved in FDX, which is the standard setting organization, whose CEO, by the way, is an ex-Chase executive, and that Chase has been incredibly involved along with a lot of the other large banks in setting the standards, and sometimes to the angst or frustration of fintech companies or data aggregators who feel like the banks have exerted too much influence in FDX and in the standard setting. They all felt like, hey, we did the rulemaking, we've been working together to set standards, and they felt absolutely 100% blindsided by the lawsuit from BPI, right? Like they felt completely blindsided at the time. And that was just the lawsuit, to say nothing of the CFPB doing its weird, we want you to vacate the rule and then flip-flopping thing, and to say nothing of Chase's really aggressive pricing gambit that they went out with. And I think you're right to kind of question, well, how does everyone come back together and sort of rebuild that trust, right? Like the next set of FDX like board meetings are going to be really weird, right? And like kind of awkward. And I don't know how those are going to go. And I don't know if I was a fintech company or a data aggregator, if I would ever be able to trust Chase, PNC. Like, I just don't know that I would ever be able to fully trust that. And what does that lack of trust do to standard setting, to negotiating data access agreements, to working out issues that the market is probably going to have to solve to a degree, like liability? And then, Kiah, the other thing you mentioned that I want to just double click on real quick is you talked about who's going to have influence. And this is the other part of the whole argument I've been making, which is that Chase sort of overplayed its hand here.
Yeah.
I think Chase is sort of accustomed to being the biggest, baddest lobbying force in bank regulatory circles. And like, we have the best lobbyists, we pay the most money, we are in all the right circles, we have the most influence. And so we can generally steer a thing in the direction that we want it to go.
Yeah.
And, not that I'm thrilled with the way that the current administration deals with matters of influence and lobbying. Like, I am not at all. But it is kind of interesting, just anthropologically, to watch Chase, which is used to having the most power in that instance, sort of like be blindsided by Tyler Winklevoss, like coming over the top and being like, no, actually, I have more influence in this White House than you do. And I can get someone at the White House to call Russell Vogt, who, by the way, I don't really get the sense that the current CFPB leadership really cares that much one way or the other on open banking. Like, it's not like they're
not true believers. They're not.
They really aren't in any way. Like, I don't think they have any philosophical beliefs about open banking. I think what was happening before with vacate the rule, do all this stuff, was they're just trying to tear down the Biden era CFPB and everything that it did, more as like an intellectual exercise of what can we do to the CFPB to tear it down. But they didn't have any special like philosophical
they're not like
against
open banking.
No, nor are they really for it. And I think in that instance, the danger that you run is if someone at the White House calls and goes, hey, our crypto people are really upset about this. Can you just do it this way instead? Like, we don't like this. Like, that's going to play really strongly with the CFPB. And to your point, like, this is not exactly like Chase is not exactly like a populist ally, right? Like, they're not exactly the face of populism. And so I worry for Chase that
we go into this, the largest bank in the U.S. by assets.
If I'm putting on my pro Chase hat here, I would worry for them that they're not going to have the same level of ability to influence and steer this rulemaking process, this accelerated rulemaking process that they had even under the Biden administration and under Chopra, to say nothing of prior generations of how all this has worked. And so it's a very weird situation that they're wading into.
Yeah, but Alex, counterpoint to that, I would argue we have a word for when a company can exercise pricing power that the industry, like users of that service would say is kills them. And it's not a good word. And we actually have, I think this agency is still in existence, but we have multiple agencies that should be looking at any company that seems to have monopoly power. And if Chase, in its one move, can put on insane pricing and no one can stop them, that's a monopoly. and if it's BPI, that's an oligopoly. And I would be really, if I was them, I don't know, like maybe they don't think it's a monopoly or oligopoly. This is solely from the external reports. All I can see is that there are companies that have enough market power that if they don't have a price cap on them, they will exercise not market pricing, but punitive monopolistic pricing. And we used to have agencies that made that their problem. And I don't know if we do anymore. And it wasn't the CFPB, right? Like the DOJ looks at monopolies, right? And so you're talking over here, like, I'm worried about how much influence Chase will have. And it's like, I'm not. Like, this is a monopoly and we all just saw it. Like we all we all kind of witnessed like
what it looks like.
We shouldn't, when we talk about too big to fail, we're talking about like, they're too important to the economy to just like go down all at once.
Yeah.
But like, I think we need to start applying too big to X, too big to whatever. Yeah. Because this was an instructive dispute, right?
I totally agree. And just for clarity's sake, when I was saying I worry for Chase, that was not my Alex hat. That was my like pretending to be on the board of directors at Chase hat. Yeah. This is my let me worry on behalf of the largest bank in the world hat, which is not a hat people wear very often. Yeah. But I think you're right. I mean, if I put my Alex hat on, I've written about this in the newsletter, it is a bad look. And Chase has tried to frame this as other things, right? Like we're looking out for customers, we're protecting their data.
Like I said, I'm sorry about the YNAB thing.
Kiah apologized. Honestly, that should be enough.
Honestly, if Chase was like, "Hey, Kiah, you use up a ton of APIs. Can we just like add a $10 fee a month for it,
sure.
Or like you won't be able to do it, and you'll have to manually update your YNAB account. Like at least like throw it back on the consumers. I don't know.
Sure,
did we try anything here before we did this like pricing sheet?
Well,
but yeah,
and there's no, and there's a lot of other technical ways that you could address like actual concerns about system usage, and there's a whole liability payments thing that can get solved, I think, through other mechanisms. But at the end of the day, like the too big to fail point is a really good one. Chase occupies a very unique, regulatorily approved, quasi-government guaranteed position in the market, and it always has rubbed me the wrong way when Jamie Dimon comes out and is like, what is the government, doing, getting in the way of me running my business? And it's like, dude, like the government authorizes your business. The government has given you, in some senses, your business. Like you occupy a position that is privileged by its default. That's what a bank charter means. And that's what a systemically important financial institution designation means. It means you are run by the government in some senses. Yeah. And so the government is, in fact, doing its job when it says, we're fine with you doing these things, but we would really like it if you did this. And we're going to require you to do X, Y, and Z.
Yeah.
And like, quite frankly, that's just the cost of doing business. And I would, to your point about like the objections here and the good faith part of it, it would have been a lot easier to swallow if it was, the 300th largest bank in the country going, we're going to do this, or we think this is fair, or whatever. But like when it's the biggest bank that has a stranglehold on the retail deposit market, it just strikes you differently. And again, that kind of goes to this question of going too early and overplaying your hand, which is the conclusion I just keep coming back to with what happened and kind of, where we're going to go from here.
Yeah. This all, I am interested to see how the pricing mechanism works. And it does feel like there's like a Durbin parallel here, which is that when the interchange cap went into effect, consumers were learned that this thing that they thought was free was actually not free. And that, as like, I do think we should ask ourselves, like, what direction is API traffic going to go in? Why does it have to be like this? How much activity is needed? And then how are we going to pay for it? Because if their numbers are to be believed, and I don't think they're not to be believed, that's a lot of traffic. And it's probably like 1,000,000% more than it was like 10 years ago or 5 years ago, right?
For sure.
And then in the future, it's going to be 1,000,000% more, right? Like like it's logarithmic at this point.
It's going up,
And so like we do have a question here, which is like you can kind of pay for these calls, fractions of pennies, whatever, but like it's the activity itself that's going to be the problem. It's not really the price of the problem. And they are trying to, and so I do wonder, at what point do consumers have to say, like, I don't know, I just feel like every single fintech wants me to connect my bank account, and it's so weird. And it's just like, I don't think we need all of these things. And maybe I need to be a little bit more choosy. Maybe like Plaid needs to offer me an account that I pay like $20 a year for, and then that covers my API calls. I don't know. Like, I just don't know like what's possible here. And at what point do consumers really need to understand this is not a free service?
No, I totally agree. And we continually dig ourselves a huge problem, I think, in financial services when we teach customers that the thing that costs money is free. It warps all the incentives downstream of that. And the Durbin Amendment and free checking and all this stuff is a good example of it. I think API access is another one. I mean, you and I have talked about this before, but it's like the fintech services that are built on top of this, maybe they should be charging a fee, right? Maybe they shouldn't be teaching consumers that their stuff is free either, right? Like we do need to break this addiction to growing market share in financial services by pretending stuff is free and subsidizing it in other ways that have other costs, right? So I think that's totally fair. I also think, and this is something I'm going to do some research on and probably write about in the future, but I do think we have enough examples from around the world in terms of other countries that have implemented this, that we should be able to learn sort of normatively, like what works best for creating a balanced open banking ecosystem, because they do it in Australia, they do it in India, they do it in Brazil, they do it in the UK, they do it in not Canada yet, maybe never. Canada's too stable for open banking, but
that's going to be one of my newsletters, is what's going on with the Canadian banking system.
Trust me, can I tell you something? Whenever you write about Canada, just be prepared for some very polite but very mad people writing back to you in your inbox going like, hey man, like, love your newsletter, but what the hell? That's happened to me.
I'm not going to write
times.
mean things. I think Canada, we could learn a lot from Canada's banking system. Maybe not in the open banking arena, but
this is something we need to turn into a debate. But no, I mean, I do agree.
Good or bad.
right. Future episode. So anyway, to wrap up on this one, I do think that there are some normative discussions that are worth having about like what's the right way for this ecosystem to work. And the challenge, of course, is how much discretion does the CFPB have under Dodd-Frank to make those determinations? How much discretion do they have in a post-Loper Bright world? See, Kiah, your bank nerd rubbing off on me. So I think that stuff is things that we're going to have to work out over time. But anyway, a topic I think we'll probably revisit in the future.
Like, we can't even talk about this today, but the corner post decision was actually re-argued. And I didn't realize 15 years after the interchange cap was set, it was actually too high and wrong this whole time.
Apparently it was.
According
to a judge in like
fraud.
North Dakota, maybe?
Yeah. So the second most, probably the Chancery Court for Delaware, whatever, for banks. No, I didn't realize like gas station interchange didn't have to cover fraud, which never happens at gas stations. And so,
Correct.
I have a whole, I'm not a defender of interchange, but I got so mad when that came out. Like you were off your rails. Okay. So
wild.
That's not what we were going to talk about though.
Well, no. So there was another thing that came up that's been kind of burbling for a little while. And I selfishly asked you, as I do on this podcast, at least until you take it from me, that you do a little research and educate me on national trust charters, which I'm seeing all over the place, and that our friend Jason Mikula has done some great writing on, but like we haven't talked about it. Kiah, what's up with this?
Okay, Alex, I am not rich enough, so I don't use a trust bank, right? I don't have like a family trust. So, and it was funny because there are several large trust banks in the country, Northern Trust, BNY Mellon, and State Street. And like, you kind of had to pay attention to them from like an asset perspective. But they're like very different banks than what I would say a commercial bank is. And so I would ignore them at S&P. But now I have to pay attention to them and really, and this is one of those times where you learn that there's different types of charters, and then you have to learn like the different nuances of them. And annoyingly, I have to do this work because of crypto.
Yes, indeed. As is so often the case with things that annoy you, it's because crypto is.
I have to learn about these like old ass trust charters because crypto wants them.
They discovered
and we should
them.
be very curious about things crypto wants.
Yes.
So the other thing too is like we're talking about this because in 2025 we've seen a lot of interest, but actually not even 4 years ago this same thing happened.
Yeah.
So, but we weren't podcasting then, so we can.
I know. So we can pretend like, that didn't happen.
Okay. So the news is that everyone wants all the crypto people want a national trust, a national trust charter. They are applying to the OCC for these charters. The OCC has a digital assets application page because I'm sure they're getting enough requests about that. And among those that have applied includes First National Digital Currency, Fidelity Digital Assets, Ripple, and I think BitGo. And then separately, Wise has also applied for a national trust.
Saw that.
So what is a national trust? National trusts, they're like, I don't want to say it like this because I think this has a bad connotation, but they're kind of like narrow banks.
Well, we're going to talk about that because that's the thing with
narrow
them. But
banks are like a little separate. Like narrow banks were literally like
slightly different.
Reserve, master account.
But a national trust charter, and you correct me where I get this wrong, it's narrow, right? So you can't take deposits. You're not an insured depository institution. Yeah. You can't lend any money, but you can custody assets for family trusts, for I suppose I don't
know who else has trusts. I don't know, like
trusts?
Foundations have trusts.
Foundations,
maybe companies have trusts? I don't know.
Well, I think like a law firm keeps money in trust for their
escrow?
Like I mean, there's
giant FBO accounts.
These giant FBO accounts. So like these exist, right? Like I just need to custody money and keep it safe.
Yeah,
and then I need to send the money out when I need to send the money out. So there's access to the payment system, right? Which is relevant.
Yeah, that might be important.
Might be important. And then tell me how they're regulated relative to your average commercial bank.
So they are there's different capital requirements because they're not lending. And so the trust banks, because they hold their assets on trust and not on their balance sheet, the capital requirements are different. It would be regulated by the OCC, but under a trust examination. And I'm not 100% sure what that entails. Apparently, it's maybe easier because these are just different types of risks. And you would just want to make sure that like not all the money gets stolen, I guess, which is under the traditional trust model.
Yeah. So like cybersecurity as like a risk would be one you'd still pay a lot of attention to.
Yeah. Or like, I don't know, maybe back in the day, bank robberies were a bigger deal. Yeah. But there is like, I think a concern that that institutions that receive trusts, but for crypto would receive maybe different examinations than like a commercial bank that receives a normal de novo charter. Now, I will say, in 2020 and 2021, one crypto company was approved for a national trust. That bank is Anchorage. And so they have been supervised by the OCC for several years. And Anchorage published a blog in January, like basically saying the OCC actually is a great regulator for these applications because they have experience and no one else has experience. And so that's the applications, right? That's the trust. That's not the controversy. But obviously there are people who do not want these companies to receive trusts.
Whenever there's a surge in applications of anyone getting any type of charter, all the people who have the charters get nervous to varying degrees. So who's getting nervous right now and what arguments are they making?
So actually, and this this letter was filed like before some of the applications were filed. So whatever. It's the ABA, the Consumer Bankers Association, the Independent Community Bankers Association, the National Bankers Association, and then, very excitingly, a credit union, which if you are bringing the credit unions and the banks together, everyone's
You've
worried.
achieved something great. Yeah. Well done. Yep.
So they sent a letter to the regulators arguing two things. So the first is that the public portions of these applications don't provide enough details for meaningful public scrutiny, because there are public sides of the application and there are private sides or confidential sides.
Right.
And then two, that awarding these trusts charters to these companies is actually a change in OCC policy as it relates to the definition of trust activities and requires public scrutiny. So there's two arguments. And it's interesting because I guess you could argue that to the first argument, argument the first, that's just not what regulators do. They publish the public side of the application, and then they keep everything else. And I can't go ask the regulator, I can't FOIA it because it's been deemed confidential under whatever the secrecy or whatever, confidentiality, trade secrets. And so it's interesting they're making this argument because they're a de novo bank is also the applications are being treated the same between novel trust bank application charters and traditional de novo application charters. And so they're basically asking for an exception.
Yeah. Well, and just because they're a lot of these companies applying, I don't really get how that means that the standard that they use, it's not like the OCC is not reviewing the applications in their entirety,
Correct.
right? It's just not all of it is public.
Right. It's we're not allowed to to look at it, or they're not. Really, the trade groups want to see what these applications, because they probably want to pick them apart. Which
I understand, but that's not their job, quite frankly.
Yeah. I mean, other than the ABA issuing the routing numbers, there should be no.
You don't have any involvement in this. This isn't your job. Stay in your lane, bro. So that's one argument.
And here's the thing. I'll co-sign this if I can get confidential application information from a lot more than these applications. You better be really careful. This is one of those arguments where you better be careful that how you make it, because they're just trying to be well, this group's special, but the other groups are fine. So confidential treatment applies to the other groups, the normie banks, but not for this group.
Right. Couldn't I just say well, hey, I'd love to get access to the bank's confidential supervisory exam reports?
I'd love to see some reports of examination in some of these banks.
That'd be amazing. That'd be in the public interest,
if I'm an uninsured depositor, don't I need to be looking at how safe my banks are? Don't I have an interest, right?
That's right.
No.
And Kiah, you have massive amounts of liquid assets.
So I'm uninsured deposit rich, but not trust bank rich. No, I'm not. Okay, so the argument the second was, I read it, and it was what I would describe as significantly more technical than I was anticipating.
Yeah, your explanation in the notes for this episode did not exactly make it clear to me. So try your best.
So it stems from, as far as I can tell, two definitions, the word custodian and the word fiduciary. And so and then I had to go back. To 2020 and 2021. And actually, this makes me think I'm going to have to write about it, because the OCC issued several letters in 2020 and 2021, interpretive guidance. One was under Brian Brooks, and was hey, custodying crypto is custodying. Or whatever.
It counts, yeah.
It counts. That activity is defined under custodying. And then in 2021, there's a presidential change in administration, and then the OCC.
I remember that.
The OCC doesn't rescind that first letter, but they put out a second letter that's so yes, we will allow that first letter to stand, but you can't do this activity unless you get a non-objection from us. So it wasn't a full 180, but it was definitely slow your roll. And that's where between those two letters coming out, a bunch of companies applied for national trusts.
Yeah.
And I think the OCC wanted to give itself some flexibility and like take back some of its power and like kind of telegraph like it's not a free for all.
Yeah.
Okay, so now that's not like we've had another change in administration. And so the OCC has actually rescinded this second letter. So, and like, I don't know.
So no more non-objections.
No more non-objections, but the first letter stands. And
so custody still counts for crypto.
Yeah. And so it seemed like, in 2020, apparently these trade groups also argued with that letter. And I don't think they like sued. I think they were like, one of the issues is that this was issued as interpretive guidance. It wasn't a rule. Which is kind of hard
to, right.
But like guidance isn't rulemaking. Like famously in 2019, we're just listing off years, but in 2019 and 2020, there was like, it was when McWilliams was at the FDIC. There was like guidance that came out that was like basically like guidance is guidance. It is not rule. If you want to tell someone it has to be this way, and they said this for like supervision and examinations. If you examiner want to tell a bank like you're doing it wrong, I said so, you have to be able to point to a rule. And you can't point to a letter of or interpretive guidance. And so this whole like letter citation guidance is guidance thing is really interesting to me, and it's like not settled. But basically the OCC has published this letter of interpretive guidance of like, here's how we interpret this thing. Like basically it was like, hey, just heads up, this now counts.
And by the way, just as a side note, like, and you know me, I'm appropriately skeptical of crypto stuff. I maybe some people would say too skeptical of crypto.
It can't be more than me. So
it's not more than you, and I wouldn't say it's too much. But I'm
undeserved. Importantly,
not at all undeserved, based on just having been alive for the last 10 years. But the thing that when that argument about like, does this count for the purpose of custodying? I think it kind of does. Like, I hate to say it, but like, isn't that exactly
tell me how it doesn't count. You know what I mean?
Like, isn't custodying assets for crypto just a different version of custodying? Like, it is, right? Yeah. Like, that is what it is.
You know what? I also like, I need to like look up more, but I think Bank of New York Mellon custodies crypto.
They do. They're a huge company that does that.
And the only reason why I know that is because of a special accounting treatment that they received for it.
They do. I mean, like the big custody, the big trust banks are the major bank partners for the crypto ecosystem and for stablecoins specifically.
So, like, again, tell me how it's not. And like, genuinely, I kind of don't know. And maybe it's because I'm not rich and don't have trust, and I don't understand. Like, okay, if I like. It's weird because they don't take deposits, but if I have like a bunch of money in a trust and then I put it at a bank, that's normally becomes a deposit and a liability. But not somehow, if you're just the overseer of my thing and I pay you a fee and you don't touch my deposits, then it's not a deposit, I guess.
So that brings us to the thing that I wanted to...
Sorry, now we're at the limit of my knowledge
No. I mean, you brought us right to the edge of the conversation, because this is the thing I wanted to ask you about. So... I have noticed that in a lot of these arguments, there'll be the things that the trade associations say, and then there'll be the thing they actually think, but they don't say. And the two are not like, they're always synonymous, right? And a lot of times the thing you're concerned about, and this is the open banking chase thing too, right? The thing you actually want to stop or that you're worried about, if you say it out loud, you look like a monster, or you look like a monopolist, or you look like someone protecting your incumbent advantage. So you say other things, you make more technical legal arguments. Yeah. Isn't the actual objection here that a national trust charter was originally envisioned to be a narrow type of bank charter for banks that wanted to be in the business of custodying assets that were illiquid and not used in a transactional sense? And as such, they obviously aren't treated as deposits. You can't use them as deposits. You can't lend. So you're not really a bank. You have this narrow kind of regulatory treatment, but you do have a bank charter. You are considered to be a bank. And importantly, you get access to, if the Federal Reserve deems it okay, a Fed master account and sort of the access to our payment rails, because you need to move the money in and out of the trust account in, I would presume, a relatively infrequent basis, the way that a trust would work, right? So you fast forward through all of that, and now we have stablecoins. And stablecoins are a type of crypto asset, a token, that requires the custody of backing assets, right? Under the Genius Act, it's treasuries or overnight repos, right? It's like very like liquid, very trustworthy assets that need to be held in reserve for stablecoins. So you need to keep those reserves somewhere. You need to have someone custodying those assets. However, Kiah, the difference is that stablecoins sort of function as deposits, right? Like stablecoins can be used.
Yeah, it's funny because it's like
that's the part that I think is like, if you're going, oh no, this is not a misuse of the National Trust
Charter. It's funny because it's like,
yeah, it is, because these are deposits.
Alex, in my nerdy bank, I'm going to have to. It's funny because I have thrown the word deposits around for fully 15 years, and stablecoin. Your question of like, doesn't it function like a deposit? And it's like, I don't actually know, because like I feel like I know how deposits function in banks.
Sure.
And they like move around in when money enters our banking system and it's moved in, it like moves around as a deposit. And then it's like, okay, but like, I don't know. I was looking up tokenized deposits because you were going to make me maybe talk about them, and I'm hoping this podcast.
You might have run the clock out on that conversation.
I was working so hard.
I know.
But I was like, why are we using different words? Like, I don't understand why the words are different. And I'm like, maybe I'm missing something. Maybe I'm missing something really important. But the same with stablecoin. I don't know why these words are different.
No. I mean, you're exactly right? The critique of the Genius Act was that it was defining stablecoins by what they aren't rather than what they are. Right. And it's like, tell me what the thing is, actually. But like, I think about it in terms of utility, right? So like, what does a deposit do? Well, okay. A deposit is a safe place to keep your money. A deposit is a transactional mechanism that allows you to pay people and to move money around. A deposit is, what else? Like that kind of functions. Well, I mean,
for
like
banks, deposits are a debt, right? So the most important thing we have to know is that they're a debt, and the bank takes the debt and then lends that out, and then they make money. So that's
right. And to me, critically, that is the part where stablecoins are not deposits, right? Because the Genius Act does not allow you to lend out against the money that you're bringing in for stablecoins. The reserves have to be fully backed. But really, and this kind of ties back to what you were saying earlier, doesn't that just mean that these national trust banks are now just becoming fully narrow banks? Isn't this narrow banking, where it's a deposit in the sense that it's a place to keep your money, and it facilitates payments because you have access to payment rails and you can like move the money in and out easily? Isn't this narrow banking? What am I not understanding?
Narrow banking has actually a very specific definition that it specifically involves the Federal Reserve. Something that I thought was really interesting. You kind of assumed they would get reserve accounts.
Is this a bad assumption?
Just having the charter does not necessarily mean you will get the reserve account.
But we are also adults living in the world of the, regulators.
I don't know if Mickey
doing
Bowman's wants them to get reserve accounts.
Well, that's the question.
It's a separate application. Well, I can say it's a separate application.
It is.
The Federal Reserve has been forced to say it's a 3-tier system that they evaluate. Yes. I would say under their tiers, I think we can say safely that commercial banks have like the easiest that will have the easiest
tier 1
application process. Mm-hmm. And I believe that digital crypto banks that have a charter from someone, right, they're not tier 1.
Yeah.
And so the whole time,
meaning they have a harder ability,
they have
a higher road to go up. Yeah.
And like so I was looking if Anchorage has a a master account in the Fed's database, and I can't find it in either the request for access or the existing access. Yeah. Protego applied. They were tier 2, and
Yeah.
they applied in 2022. And under it says pending. So,
which could mean never in Federal Reserve language, potentially.
Yeah.
Or not.
And so I think that it's one of the observations I was making is like, I actually think it's really interesting that the trade groups, are they worried that the OCC is not going to do a good job supervising these institutions? Are they worried that like the OCC, I think one of the things is like the OCC under the Biden administration, I think was less interested in giving charters to anyone.
Yeah, right.
And they don't have that OCC now. They have ostensibly a more industry-friendly OCC.
Well, Rodney Hood basically sent the call out that like the doors are open. And I know he's now been replaced by Jonathan Gould, but like the message being articulated through the administration going out through the banking regulators is, if you want a charter, now's the time.
Well, also if you want to, if like I'm interested to be like, who gets charters for what? And if you're qualified, if you're otherwise qualified for a charter, you're just an unusual applicant.
Sure.
Shouldn't that charter application be assessed on its merits rather than on an ideology of who gets bank charters and who doesn't get bank charters?
Well, I think so. But then let me ask you this question. Let's say that whichever one of these institutions, we'll just use Circle as the example because they're pretty buttoned up from a compliance perspective. So they get, let's just say they get a national trust charter, which, they're not dumb. So if they've gamed this out, they probably feel like they have a pretty good chance. And then let's say that they go and apply for a Fed master account, which they've said they intend to do. And the Fed is assessing that master account application. And even though it's coming from a different tier and they want to be more careful in evaluating the risk, that they come back and say, we really don't see any risks in terms of this being used for money laundering or this introducing like, kind of systemic risks or anything. Is it acceptable? And this is a question I just don't know the answer to. Is it acceptable for the Federal Reserve to still say, this is narrow banking. This is not the banking system we have or the banking system we want. And therefore you don't get access to a Fed master account, even though
we would
in
prefer
every
if
other
our
respect,
banks do monetary policy with our accounts.
Well, right. I mean, at some point, the Federal Reserve is making a normative judgment about the type of banking system we want to have, even if the applicants have a trust charter and are deemed in every other respect low risk. If you're coming to me and saying, hey, we want to do narrow banking, it kind of is the Federal Reserve's job to say no, right? Or unless I'm misunderstanding. I guess we need to ask Mickey Bowman.
I know we could ask Julie Hill to place odds for everything.
Yeah,
I know. Just every year she has to come back on for one
explain
area of her
again.
aspect or research. But I mean, in the past, the Federal Reserve has cited that. I don't know if that's the wishes of their heart. I don't know if there's a secret thing, which is we think you're giant big money launderers, but we can't say that. It's very rude for us to say. So we'll just say that you are going to be a narrow bank and we don't want narrow banks. The Federal Reserve, it's the Federal Reserve's thing. They can kind of change it. And I think one of the things I was arguing is if the OCC falls as the ideological barrier to these institutions getting charters, the question is the Federal Reserve the final one to fall? And we will find out.
This is the Jon Snow standing alone with the sword as horses charge at a meme. Is that the Fed just holding the line here?
And in the past, the Federal Reserve has given away master accounts. I think the state of Tennessee has a master account at the Federal Reserve. We're not enacting monetary policy. It's just so we can pay people easier. It's weird.
Right. Sure.
And so they act like this is a precious thing. And I think it's a privileged thing, but it definitely is we need to understand that when you run a payment rail and the question is, does anyone get to merge onto the rail or connect to the rail? Or how good does your argument have to be that you have access? And
how rigorous and unbiased does the Fed's process need to be around this, which has been a subject of scrutiny.
The other thing too, you know what I need to figure out again with these stupid national charters that I need to research about, or trust charters, trust charter is does Circle have to become a bank holding company?
That is a
Because I know with
marvelous
ILCs,
question.
they don't. That's like a really specific thing about the ILC charter. But if Circle has a national trust, I would assume there's a parent co. That's a public company, in fact. And if the Federal Reserve is like, oh, you can have a master account, but you got to be a bank holding company, and we're going to come in here, like, I don't know. Is that the trade they're looking to make?
That might not be fun. Yeah. Well, no. And I think the last thing I wanted to ask you about, and it's tangentially related, but it's important with this one is, can we talk about Erebor for a second?
Is that how you pronounce it? I'm not a nerd. I'm like not a nerd in that way, so I didn't.
Not a nerd.
know.
Come on, Kiah Haslett.
My fantasy world is like not Lord of the Rings. Okay.
I know. Top Gun with dragons. So the Erebor, for those who are listening and who don't know, is the de novo bank, I guess would be the right way to describe it.
Yeah, I looked and it's a de novo bank charter.
De novo bank charter. So this is a new bank that Palmer Luckey, the CEO of
Anduril? Is that also a Lord of the Rings word?
Yes, it is.
Okay.
So this is like part and parcel of the Peter Thiel, everything is Lord of the Rings in his brain world, which hate it. And the only thing I'll say is that J.R.R. Tolkien was actually really opposed to like industrialization and war, generally speaking.
Yeah.
And so the idea that all of these large companies, many of which work in the defense industry, are borrowing names from words that he coined probably wouldn't thrill him. So anyway, set all that aside. It has been reported that Erebor is going to be this digital bank that Palmer Luckey is starting that I think aspires to basically replace Silicon Valley Bank as the bank of choice. Yeah, awesome, right? As the bank of choice for startups, VC-backed companies, crypto companies, like the defense companies, kind of this like new industrial finance defense right conglomerate of corporations. I don't know. Because of the connections that they have, I think they will be very successful in attracting business, right? A thing I've noticed is that the VC tech ecosystem tends to sort of take care of their own. So one imagines that they would be successful in attracting customers when they are able to launch.
Large uninsured deposits. Never taking out loans.
Let them flow, man. Let them come in. And
this time it'll be different.
It will be totally different, Kiah. Well, and so related to all of that is some reporting that came out recently that suggested that a part of their pitch that they're telling investors is that they will also leverage Palmer Luckey and others' political connections to expedite the process of getting their national bank charter. Now, to be clear, this is not a national trust charter.
Correct.
This is a fully fledged de novo national bank charter, also with the OCC. And Kiah, the reason I wanted to bring this up is A, it feels like this bank is going to be a major player in the crypto ecosystem. And B, what did you think of this argument that, even though ordinarily it takes a while to get a de novo charter and it's kind of pain in the ass, we can expedite it because of our political connections. What do you think about that?
Yeah, no, I think that's bad. I think it's an unequivocally bad thing. I think it's bad that he feels comfortable saying this. Even
in a private context.
Yeah, like it's definitely an inside thought all the way around.
Like a don't ever put this in a PowerPoint thought kind of thing.
But this, I think, is... I think one of the things about the banking industry is like the perception, like legitimacy matters. And sometimes that's really annoying to kind of encounter. But that all of us in the banking industry care about our images, right? Because you really need people to believe that you can manage the risks that come with maturity transformation and lending and aren't going to fail. And so this gets telegraphed in a lot of different ways at banks. It's big bank vaults and marble and everyone wearing suits.
Nice pens.
Yeah, right. Because they're all just trying to telegraph seriousness and conservatism.
Yeah.
But I would also think that the regulator also needs to telegraph certain things. The regulator needs to probably telegraph that they're like more conservative than the bankers, and that they're serious and that they're fair. And again, I use the analogy in soccer a lot, but if someone was saying this, if a team was saying this about referees, it would be a scandal. It would be a scandal. That referee's reputation, if it was in any way seen as like true, would be destroyed. And
wouldn't that referee in the next game they had with that team go out of their way to demonstrate their independence?
In my world, in my referee world, that referee never sees that team again. That is how serious these allegations would be taken. That there would be a hint of favoritism, that you cannot be objective.
You're not going to be assigned to that team.
The other team would never believe this referee, right?
Yeah.
There are, and so you would want to make like this, I think is very, I don't think the OCC should necessarily comment on this, but I think that this is very bad that someone says this. And I think it puts the OCC in a very awkward place, because if it's anywhere close to 6 months for a de novo bank charter, like,
right. Which is normally
what would we think? It's okay. So Vero took 3 years.
Yeah.
To get a charter from the OCC.
And from everything I've heard, it was ridiculously difficult.
Yeah, and Vero is like, to be clear about it, like it's just a digital consumer lender. And I want to say that like it's like kind of bread and butter relative to some of these banks.
Yeah, it's Chime-esque in a lot of ways. Yeah.
And then Protego, which had a state charter, they were granted conditional approval by the OCC to convert to a national trust charter in February 2021. That expired in 2 years, and they couldn't do it. Like, so
it's a long process.
The OCC was like, I don't want to say they were backburning, but like, and I'm sure like I believe the OCC if they're dragging their heels on this stuff in a way that like with M&A applications, I kind of am like, okay, I think you're taking a little too long on some of these.
Yeah. But on de novos, it's like a way of thinking about it is we're letting you into this exclusive club.
Yeah.
The whole point is we need to know that we can trust you to do this. This is why there's that kind of probationary period, right? Where you have to like not deviate from the business plan that the OCC approves. Like there's a process to go through. You and I have maybe criticized the process in the past as being too onerous and discouraging de novo formation, which is kind of ironic that we're on the other side arguing it. But like, I think you're right. It undermines the legitimacy of, I think, all regulators, quite frankly, if you can demonstrate that like my political connections will allow this to happen. And quite frankly, like to tie it back to the Fed master accounts,
and
this is the same thing. And open banking, like this is the same thing that we see in other areas, right? Like, oh, well, this applicant for a Fed master account has someone who used to work at the Fed on their board and they got approved. Like that doesn't look good. The crypto company calls up the White House and suddenly the CFPB is reversing its position on open banking. Like that doesn't look good. Like these things, even though you can understand the political realities behind it, like these institutions are supposed to have credibility that supersedes and outlasts any one political era. And it's very damaging to them when that doesn't happen.
Right. And I think like, the OCC, it was interesting because I think it's funny that all these like companies want a national charter, because I was not under the impression that the OCC is a particularly easy regulator.
No, I've never been under that impression either.
So
it wasn't like the Office of Thrift Supervision back in the day.
Right. And so it is interesting that like they are opting for this. Also, on the name thing, so I don't like Erebor, but also you and I have talked about bank names before.
Yeah.
And I think that these, like, think about it. These are crypto banks. These are digital, like innovative, on the forefront. And the names that they have come up with, let's just laugh at them for a second. Fidelity Digital Assets. And then First National Digital Currency.
Which is the Circle one, isn't it?
Which is Circle. And
but that's not Circle.
And then National Digital Trust. Which,
terrible.
Like, can we just, there's like, the word digital is appearing in all three of these. And I hate the word digital as like similar to hating the word cyber. It feels like 1998 coded.
Yeah.
And then
it's very the net with SandDB. Yeah,
right.
Totally.
www. But the other thing too is like these are boring as hell names, and they're like they're almost like, don't look at me. You can't see me. I'm not here. They're like designed to be invisible. And I think it's so funny that they're so banal and they're like deeply uninspired. And at least like the nerds over here, the Lord of the Rings nerds, were like, oh yeah, like.
Well, can I just, all I want, Kiah, is I want names that aren't banal and terrible, like the ones that you just listed, but also please just leave Lord of the Rings alone and stop. Like, is it at all possible to be truly uniquely
we should come
creative
up with
about
like
names?
a Fintech Takes company name generator, and you can put in like
I love this idea.
a fintech name, or you can put in a bank name, and then you can put in how many vowels you want.
Love this.
And then are you okay with an EY, like, where you change the E to a Y?
Yeah.
And then should the word be from a work of literature where the copyright has expired?
Right.
Or should it be like as generic and forgettable as possible?
Okay, so we need to stop the podcast there because that is the perfect idea. And just the reason, by the way, that you joined Fintech Takes is to bring ideas like that to life. That is exactly what it is. So, Kiah, congratulations, you ran the clock out on me being able to ask you about tokenized deposits. Well done. I won't forget about that. I will circle back to that topic in the future. We also didn't get a chance to let you get revenge on potato-related topics, so we're just not going to do that because that would tack on another like 20, 30 minutes easily of us yelling at each other. Instead, I will just say this is like the most fun I've had in months. I'm so excited that you joined Fintech Takes, and we're going to do this again many, many times in the future now, which I'm very excited about.
I'll see you next month.
Okay, sounds good.
All right, bye.
Bye-bye.